Back to your personal bank show with president and founder of Secure Estate Management, Ferenc Toth.
Okay, everybody, we're back, and we were just talking about how to capture interest instead of paying it on debt that the average American, pays over $250,000 of interest in their lifetime, according to Credit.com. And why not capture some of that interest? Here's the thing. We're voluntarily giving that up through all types of debt instruments, houses, cars, credit cards, whatever it is we're doing, and we're paying that interest to someone else, a lender. They're taking that money and investing that money and making more. So they're not taking it from us. We're voluntarily giving it to them. And unfortunately, in most cases, it's either due to emergencies because we don't have enough cash flow, which I'm going to address here in a minute on how to absolve that problem, or, lifestyle. And the thing is, that doesn't move us forward financially. And when we have situations where we're unable to make the monthly payments on consumer debt, due to many times things totally out of our control, the economy, job, business income, whatnot, disability, you name it, guess what? We have a lot of stress in our lives and bad stuff happens. So we want to avoid those kind of things and eliminate stress because that's the number one thing that having not enough money does. So how do you capture some of that interest that you are giving away voluntarily? My question is always, hey, it's over $250,000 per person. A married couple, that's over $500,000 in your lifetime. What if you could capture a portion of that? Could you use an extra $100,000, $200,000, $300,000 for retirement? I think that answer would be affirmative for pretty much all of us. So the bottom line is, it's your personal bank. This is the solution of how to accomplish capturing interest. Now, a nod to my compliance folks out there. I always love to say this. This isn't for everybody, and not everybody's going to do this. But here's the thing I want you to understand. If you have not looked at this, truly looked at this, do yourself the favor and do so. It can make a massive difference financially in your life. So how does it work? Well, if you're going to operate a bank, a personal bank, you have to think like a banker, understand how banks operate. I've shared this before, but I think this is worth repeating. It's so powerful to understand. Thinking like a banker versus an investor is simple. Investors, which is what we're taught to do, we're taught to trade hard-earned dollars for assets with the expectation the asset will increase in value over time, and typically focus on the potential gains, many times creating little or no cash flow, and rarely ask, what's my recourse if things go wrong? What's the downside protection, or the plan B, if you will? And see, the problem with investing, for most investors, is if you purchase a stock, a piece of real estate, or a business, can you tell me what it's going to be worth in a year? And the answer is no. You can look at charts, you can guesstimate, but we don't really know, do we? And again, this is not from me. This is from several different various sources and books. Investing primarily for appreciation is just another form of gambling. It is, if you think about it, because if your only way of making money, if it goes up, and if it goes down, you lose, how is that any different than going to Vegas, for example? So that's the issue with investors. Now, how does a banker operate? See, the banking industry, here's what you need to understand, is more risk adverse and looks at risk on money probably more than any other industry that's out there. So we can learn from them. Again, you can love banks, hate them. I don't really care. That's not what's important. We can agree they're savvy about money, and we can learn from them. So I always say, look, have you ever taken a mortgage or a car loan? And when you signed the papers, you knew you'd have a payment, right? Did you plan to make the payments? Well, of course you did. You wouldn't have signed the papers otherwise. And guess what? The banker knows that too, because you went through a whole approval process, didn't you, to get the loan in the first place? And if you had not made those payments, what would have happened? Well, they would have taken the asset, resold it to somebody else, and created payments or cash flow from them. So is the banker really risking their money? Typically not. Okay? Collateralized loans very, very seldom lose money for the lender. So the bottom line is, how does your personal bank work? Well, when you get a check, what's the first thing we all do with it? We deposit it in the bank. What's the bank do with our deposits? Loan it out for compound interest. So do what banks really do. Let's say you walked in the door and you wanted to open an account, and you gave them some money, and then the next person walks in the door and wants a car loan. Does the banker take the cash you just gave them and turn around and give it to the car loan person? And the answer is basically no. What they do is they take your cash, stick it in the safe, and they can borrow against that cash, that asset, to create interest payments from someone else. Okay? That's how banks operate. And can you borrow against an asset? Well, yeah, we do it all the time. Cars, houses, credit, 401ks, whatnot. Okay, do what the banks do. They don't invest in the stock market. I'm talking the banks. They earn compound interest on their deposits. That's what they primarily do. And they borrow against the cash they hold to earn more interest. So can you. Access to funds and allows you access to those, but yet gives you the long-term, say, supplement to retirement income. See, the problem is when you access an account, a typical account, when you take the money and you pay off bills or you invest it in something else, you do something else with that money, what happens to the funds that were in your account? The future growth on those funds, I should say. It stops. Here, you can actually have the opportunity to access some funds, return it back, and not lose that ongoing compound interest, that compounding factor that we've talked about before, but we all know is super powerful. You understand compound interest basically is 1 to 2, 2 to 4, 4 to 8, and so on. And the rule of 72, which is very familiar to most people, is at 7.2% interest, money doubles every 10 years. Okay? The bottom line is this. If your money is growing consistently over time and you don't take access from it, you don't take withdrawals, you're going to gain compound interest. And many people have called compound interest the eighth wonder of the world. So it's definitely something you want to work for you. Let's give you one last thought about the debt, like I talked about in the first segment. Compound interest, by the way, works both for you and against you. What do I mean by that? Well, if you have a debt and you're making minimum payments or even no payments on it, what is that debt doing over time? Compounding. So compound interest can hurt you equally as much as it can help you. So you want to be on the right side of it. You want to capture the interest on your money, have access and use of it, I should say, when you need it or want it for opportunities or emergencies, whatever that may be. Plus, have it down the road long-term to supplement retirement, for example, or pay for college or any other, or supplement your business or any other use that those dollars long-term are going to do for you. That's what the Your Personal Bank does. So the tool we're going to use to make this work, well, we use an insurance tool. Not the type that you're familiar with. Most people are not. It's a high cash value type product that typically corporations, banks, those types of things use, okay? It's not the type that's typically used by the average individual. And why do we use it? It's real simple. Compound interest. We want increasing cash flow. We want money growing every year. We want no risk of loss. We don't want to access or borrow against an asset that can lose value, so anything market-related gets knocked off the table. We want liquidity. We want access to funds if we, again, want them or need them. And by the way, I'll talk about there's 3 different ways to access funds in these personal bank contracts. It's really cool. And, of course, we want tax-favored growth and pass it on to the heirs in a tax-favored manner. There is only one financial tool that basically encompasses all of these characteristics. Now, for it to work, some people, like I was in Chicago, I mentioned last week, who had looked at this idea, and I've run into people who say, hey, I can access funds against a policy. But here's the thing I want you to understand, and I'll touch on the next segment, the difference. Most of the time when you look at these contracts, there's little or no money available in the first few years. So yes, you can borrow against the contract, you could access funds, but you can't touch it for several years. And I was showing a difference, a significant difference, where you could access a significant amount of funds, either again through the policy, as collateral for a loan, a traditional lending, or you could even sell it down the road. The bottom line is it has to be structured properly. There's specific riders that are used that are at no additional cost, and it has to be accessed correctly through the policy loan provisions that have to be available in the contract. Also, depending on funding, there could be limited access to cash values in the future. Obviously, the more you contribute, the more you'll be able to access. That's the bottom line. We're going to go into this a little more detail in the next segment and show you how to know whether you have the right tool or not. Tune in Tuesdays at noon on Money Radio for the Your Personal Bank Show.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com.